The political circus is gearing up for 2024. Meanwhile, Americans are suffering from the costs of the political elite. Join the Mises Institute at Fort Myers, Florida on November 4th for an event dedicated to the White House, the Fed, and the economy. We'll cut through the campaign rhetoric to look at the future of the U.S. economy, with a lineup including Bob Murphy, Patrick Newman, Jonathan Newman, and Murray Sabrin. Register now at Mises.org/FL23. Human Action Podcast listeners can receive a special $10 discount using promo code FL2023. This is the Human Action Podcast, where we debunk the economic, political, and even cultural myths of the days. Here's your host, Dr. Bob Murphy.
Alex, welcome to the Human Action Podcast.
Thank you. Great to be here with you.
Yeah, I'm glad to have this conversation. I'm looking forward to it. I've been following your work on the Fed. Before we dive into that, though, I did get feedback from one of my listeners at one point saying, hey, if you're bringing on somebody that we may not have heard from before, can you give a little of the background? So I know you've got a background that's very relevant to what we're going to be talking about today. So maybe before we dive into the material, can you just explain your autobiography?
I can. I started working in banking in the year 1969, having before that been a student of philosophy, and I found a philosophical approach to financial problems very useful. I think that fits quite well with the Mises Institute philosophy itself. The year 1970 brought the first financial crisis that I lived through, many coming. It was the collapse of the Penn Central Railroad and the panic in the commercial paper market and the bailout by the Fed. Well, we've seen that. I have seen that many times since, in the 1970s, the 1980s, the 1990s, the 2000s, and the 2010s, and now the 2020s. So I worked in banking up until 2004. I was the president and CEO of the Federal Home Loan Bank of Chicago from 1991 to 2004. I then joined the American Enterprise Institute and the think tank world, and have worked on, from a think tank point of view, financial policy issues and the nature of financial systems and why they get in trouble, and the nature of central banking. And how central banks are entangled in the financial system and its problems. In 2019 to 21, I was with the Office of Financial Research of the U.S. Treasury, and now I have the very great pleasure and privilege of being associated with the Mises Institute. So thanks again very much for inviting me on.
Oh, sure thing. Yeah, I'm glad to have you here, and we definitely have benefited from your experience in your talks, and I've seen you do other interviews, and of course you're writing for Mises.org. So what I wanted to have you come on today to talk about was you have a recent post, but if people go Google Alex Pollock, Fed insolvent or Fed bankrupt, this isn't something that you just started talking about 3 weeks ago. So
that's correct.
Yeah. So I suppose maybe for the listener, and I like how you said a philosophical approach. Can you maybe, before we talk about central banking, just in general, what does it mean when we say that a firm or an entity is insolvent? What do we mean by that?
There are two senses of the word insolvent. But before I get to them, maybe I could mention, if people are interested in my work, I have a website. It's alexjpollock.com, all written together, alexjpollock.com. And all of my essays, articles, books, and things, actually, you can buy my books on that website if you had a mind, are on that website, covering probably the last 6 or 7 years. So should you be interested, that's a way to do it. Now, insolvency, there are two senses of the word insolvency. One is that your liabilities are greater than your assets. That is to say, your capital is negative. That's called technical insolvency. Your liabilities are what you owe. Your assets are what you own. To repeat Accounting 101, And if what you owe is bigger than what you own, well, then you're, we say, technically insolvent. But you might still be able to keep operating. And then the other sense of insolvency means you actually are out of money and can't pay your bills. And when you look in the cash drawer, it's empty. And so your creditors are out of luck. And insolvency is not the same as bankruptcy. Insolvency, in the second sense, where you actually cannot pay, can lead to bankruptcy, which is a court overseen distribution of your assets or plan for what you're going to do to make deals with the creditors, or it could even be a liquidation of the organization. But you can be but insolvency is not the same as bankruptcy, although they're often confused. Now, the Federal Reserve is technically insolvent. That is to say, its losses are greater than its capital. Therefore, it owes more in liabilities than it owns in investments and assets. But it is not insolvent in the sense that it can't pay, because in order to pay, it can always print up some more money. That is, as long as we're in a fiat currency or a paper money system. So the Fed is an interesting special case to look at.
Okay, yeah. Before we talk about the central bank, though, I think maybe, and this is such second nature to you that, but let's, if we can, just dwell a little bit on that first distinction that you made between the two senses of insolvency, because I think for some listeners, if they're not familiar with this, they might say, I don't understand the difference. If you owe more than you own, isn't that the same thing as saying you can't pay your bills? But part of it is because the first technical sense means like the market value of your assets and liabilities. So it's not necessarily. Yeah.
We can talk about insolvency on a market value basis. That is to say, we mark all of your assets and liabilities to market, and we see if liabilities are greater than assets. But you can also be technically insolvent just on a GAAP, a generally accepted accounting principles basis, in that your losses have consumed all of your capital. That is the case of the Federal Reserve. But you can still have cash. Well, let's say, just to make it an example close to home, let's say you ran up all your credit cards and you don't have any savings and you owe all this money and you're insolvent, but you still have a couple of credit cards that will allow you to charge things on them. So you're still able to pay, even though you're technically insolvent. Or you still could have some cash.
Yeah, you could still have $200 in your checking account, but if you're just looking at what your assets and
$200 in your checking account, and you're still able to pay, but you're insolvent in the sense that you owe more than you have assets. That could happen with a house, for example, since you could have a mortgage which ends up to be bigger than the market value of your house. Let's say you bought the house for $300,000 and you borrowed $250,000, and the value of the house goes down to $200,000. Now you owe more than you have an asset, but you're still able to make your monthly payment because you still have some cash. Is that clear?
Yes.
Right. So you can be technically insolvent without being insolvent in the sense of can't pay the bills. You can be insolvent without being in bankruptcy. For sovereign borrowers, one of the most common events in financial history is the default by governments on their debt. And I'm often asked, well, how about the U.S. government? Hasn't it always paid off its bills? And I enjoy citing that there are 4 occasions in history when the United States government defaulted on its debt. But with a sovereign, you can't put them into bankruptcy. The sovereign says, I'm not paying. What are you going to do about it? By the way, I have this army.
Right.
So
I'm surprised to hear that there's 4 cases, because Joe Biden has been assuring us that the U.S. government has always honored its financial commitments.
Yeah, well, every president and every secretary of the Treasury says that's simply not true.
Now, I'm curious, are you referring to the episodes involving gold or things beyond that?
Yes.
Okay.
One in gold. The most notable default was the failure in 1933 of the government to make good on its explicit and unambiguous promise to pay its bonds in gold coin. And the U.S. government simply said to the holders of those bonds, tough luck, we're not paying. And there's nothing you can do about it. Well, what they did about it was sue them. And the case ultimately got to the Supreme Court. And the Supreme Court in about 1935 decided on a 5-4 vote that if you were the government, you were the sovereign. And if you decided not to pay, as the Congress had decided not to pay, that was it. And of course, on top of that, the government took the people's gold, gave them much less valuable paper money in exchange, and then made it illegal to own for American citizens to own any gold, either in the U.S. or abroad, with huge fines and potential prison. It was an act of amazing despotism by the United States government following on their default in 33.
And now, if I'm not sure, Alex, can I ask you, do you know that?
Yeah.
I believe you couldn't even write a contract referring to the world price of gold. Like you couldn't say, yeah, I'm going to cut your lawn and then you're going to pay me based on, yeah.
Right. You couldn't make contracts payable in gold.
I mean, pay dollars based on the gold price. That's what I'm saying. So like you could say, no, I'm not getting paid in gold, but
you couldn't index
right
to gold. So that's an example. Now, actually the most important, that's not the most important default. The most important default by the United States was in 1971. It was also a gold default when we simply refused to honor our obligation. We reneged, we defaulted on our obligation to pay foreign governments and central banks in gold for their dollars. The reason for this, I've just been reading Murray Rothbard's book, thinking of these, rereading it, on what has the government done to our money about this very interesting series of events. And since the U.S. was running out of gold by 1971, in fact, a then little-known, pretty young gentleman named Paul Volcker was working in the Treasury at the time, and he had a charge of keeping track of the chart of the decline of the gold owned by the United States as foreign governments, notably France in those days, but others as well, says, well, you're committed to paying gold, we want the gold. And the gold was on a graph that was going like this. And so our result was in 1971, we said, well, we're not paying, that's it. And in the subsequent negotiations, there was a lot of people, other countries were unhappy about this, gave rise to a famous comment by the then Secretary of the Treasury, John Connolly, which was, it's our currency, but it's your problem. Not too sympathetic. Anyway, now this is really important because that 1971 event, or if you put these two events together, the 33 refusal to pay in gold to American citizens, among others, and the 71 refusal to pay, created the modern pure fiat currency central bank like the Federal Reserve of today, which has no limits on how much money it can create by crediting its books or by printing up currency. And thereby, as the great intellectual fathers of the Mises Institute, being from Mises himself, Hayek, Rothbard, and others have pointed out, we get a perpetual problem of inflation and of constant expansion of the government power, because if you need some money, you just print it up. And so these defaults actually are very closely tied to the topic of the day, which is, can you understand what the Federal Reserve, as the world's leading central bank, we should know the Federal Reserve is the central bank of the United States, but it's also the central bank of the whole world insofar as the world uses dollars, which is the dominant currency in the world for payments and for the holding of they're called reserves, or the holding of assets in currencies other than your own country's currency. The dollar is the dominant currency, and therefore the Fed is actually, in a very important way, central bank to the world, not only to this country. And in this role as central bank to the world, it intrinsically has no limits into how much it can print up or write into its books, except when the inflation really gets out of control. Then they have to react, as we have seen over the last year and a half or so.
Mm-hmm. I think it might help the listeners to understand, just to think through, because again, I really want to hit the accounting and just to get your thoughts on, like, what does it mean? So I think one thing is the casual listener might have thought that we should explain the Federal Reserve, at least ostensibly, is like another bank in that it's not just printing up money and buying tanks and planes for the government, sending out, food stamps. It's buying assets like treasuries and mortgage-backed securities that have a yield, and it keeps its books and can report how much profit it made in a certain quarter, yes, and so forth. So can you just talk a little bit about that?
This is that's very important, Bob. The Federal Reserve Bank is a bank. It's a different thing. It's a political body. It's an enormously powerful body. In my opinion, and that of many of our colleagues, it's an extremely dangerous organization. But among other things, it is a bank, like other banks. Well, to be precise, it's 12 banks. Mm-hmm. There are 12 Federal Reserve banks. And they're numbered 1 to 12, starting in the east in Boston, and then New York and Philadelphia and so on, and going west out to San Francisco. There are 12 of these. But when we put them all together, plus the Federal Reserve Board, or technically the Board of Governors of the Federal Reserve System, that altogether makes the Fed, what we call the Federal Reserve. All right, so you add up all these 12 banks together, and like they're banks, they have assets, as you say, they have investments, they have deposits, they borrow money, they have capital. By the way, this is important. Who owns the stock? Have you ever thought about this? Who owns the stock of the 12 Federal Reserve banks? First of all, a lot of people don't know they have stock. You don't know they're corporations, but they do have stock. And if you say, who owns it? They say, well, it must be the government. But that is not correct. The stock of the Federal Reserve banks is owned by the private banks in that district, who are members, we say members of the Federal Reserve. Who is that? Well, it's every national bank, every bank which has a national charter, like First National Bank of anything, has to be a member and must buy stock in the Fed under the Federal Reserve Act, originally passed in 1913. And then banks which are chartered by individual states, or state banks, get their charter from Illinois or Iowa or Florida or whatever state they happen to be in, they may join. Now, those private banks own the stock of the Federal Reserve and have paid in to buy that stock $36 billion in the aggregate. That's the paid in capital, as we say, of the 12 Federal Reserve banks altogether. If you add them up, and the Federal gets to get ahead of our story a little bit, the Federal Reserve losses.
Can I stop you just for a second there, Alex? Again, so some people, especially like progressives on the left, they think that's all you need to know. Oh, it's privately owned, and then some people don't. Well, no, but in any event, it is a weird thing. Like, imagine if Pfizer owns stock in the FDA. Like, that would just be weird. And so that's kind of what we have here, where it's, the Fed is the thing, that regulates them, and it's owned by them.
The Fed in 1913, this was a result of a set of political compromises in the day, and some of the most important founding fathers of the Federal Reserve didn't want there to be a single central bank, so they thought that would be too powerful. a centralized, and guess what? A centralized central bank, if you happen to be printing up the dominant currency in the world, is very powerful indeed. So they thought if you had these 12 different Federal Reserve banks, which were owned by the local private banks, who elected 2/3 of the members of the board of directors. These things are corporations. They have a board of directors, they have officers, and they have a balance sheet, as we said before, that has investments, deposits, borrowing, stock, and they have a profit and loss statement that has income and expense. I was just going to say before, and I'll sneak this in here, currently the expense of the Federal Reserve altogether is so much greater than their income that they have lost not only they have losses greater than all of their capital, but on top of that, they've lost another $60 billion. These numbers are astonishing. Anyway, so in a way, they're banks. But in another way, they're agents of the government. The Federal Reserve Board is clearly a government agency. It doesn't have a balance sheet, other than some computers and whatnot. All of the banking things are in the banks. So one of the fathers of the Federal Reserve Act was a gentleman named Carter Glass, who was a congressman from Virginia when the act was passed. He later was the chairman of the Senate Banking Committee. He also was Secretary of the Treasury during his career. And it is said that he used to like to ask witnesses before the banking committees after the Fed was founded, does the United States have a central bank? And the answer that he wanted was no, it does not. It has a federal system of 12 reserve banks. So that's what the Federal Reserve, they were trying to have a federal, as in federalism,
right?
As in states and central government. You were going to have this dispersed power. Now, two things have happened in the history of the Fed, which has now lasted 110 years. One is that the Fed has become ever more powerful than it was in the beginning, and with each decade that goes by, they become more powerful. And the other thing is that the power has become ever more centralized in Washington. So it started off with this federal idea, and it has now, the power has it's almost all gravitated to the center. So that you get a centralization of power and a growth of power. Very interesting story. An old friend of mine named Bernard Scholl wrote a great book, which I recommend to you, on the history of the Fed, called The Fourth Branch. I think it's The Unlikely Rise to Power of the Federal Reserve or something like that. In this book, Bernard Scholl, Shull, says, here's a fascinating thing. No matter how many blunders the Fed makes, the more blunders it makes, the more powerful it gets. And that does seem to be an accurate summation of the history.
And just to help the listeners put your remarks in context there, like for example, there's the Bank of England, the Bank of France, the Bundesbank and such.
These days,
Bank of Canada, but they didn't call it the Bank of the U.S.
They didn't call it the Bank of the U.S. Right? Didn't call it the Bank. There's the Bank of Canada, as you say, the Bank of England, the Bank of France, the Bank of Italy. But this was the Federal Reserve for a reason at the time, but in fact, it has become the Bank of the United States.
And all that the major reorganization happened under FDR as well, like moving the power from New York to D.C. Yeah.
There was a major centralization of power in the Federal Reserve in 1935, in the Banking Act of 1935, which took a lot of the power out of the regional Federal Reserve banks and put it into Washington.
Yeah, my understanding, was that like the individual, because I remember when I was doing research for my book on the Great Depression, that before that reorganization, like you couldn't just go look at what are the assets held by the Fed. It was what's the New York Fed have? Like it was even
Well, that's still the
tabulated.
case.
Yeah.
No,
I mean, I know
actually
you could do that, but they didn't even report the aggregates, like the raw
Oh, that's
data.
right. I didn't know that. That's
Yeah.
that would fit the history. That would fit the history. So now you can see the consolidated. The all is the combination of all the banks. You can also see the consolidating statement. So you see each of the 12 Federal Reserve banks adding up to the total. Well, when you add them up to the total, they're an $8 trillion organization. It's a massive organization with the explosion of their balance sheet over the last decade. They got up to almost 9 trillion. It's still 8 trillion, which is huge.
So I know for commercial banks, for example, if they had bought a bunch of treasuries back when interest rates were really low, and then of course with the aggressive rate hikes, they might have, in terms of, if they had to market, that they would have lost a bunch of money. But so long as they can hold it to maturity, they might be okay. It doesn't have a cash flow implication. So I'm wondering.
Oh, no, it does actually.
Oh, okay.
It does actually. This is very important.
Yeah. So
this is very important.
So go ahead.
First of all,
if you can elaborate on that.
I will. It's much more likely that instead of buying treasuries, although that's often said, they probably bought mortgage-backed securities. So they were buying interest in 30-year fixed-rate loans, very long-term, with a rate that's locked in for up to 30 years. Now, these are famously difficult assets to manage successfully in terms of the interest rate risk. Now, a notable case of that was Silicon Valley Bank. Silicon Valley Bank bought very large numbers of mortgage-backed securities, tens of billions, and suffered very great mark-to-market losses on them, and funded them. Here's the key. You always have to ask about a bank balance sheet. All right, what are the assets and what are the liabilities? And a good way to get yourself in trouble if you're a bank is to invest in very long-term fixed-rate assets, especially when interest rates are low, and fund them with deposits or other liabilities whose rate goes up and down in the short term. We call that a floating rate liability. Then when interest rates go up, as happened to Silicon Valley, and this is why the cash flow is actually very important. Let's say you bought a whole bunch of mortgages to yield, mortgage-backed securities to yield 2%. When mortgages were 3%, because the mortgage-backed security doesn't pay you the same as the underlying mortgage. It pays you 1% or so less. So now you own all these mortgages, and you're going to have them for a very long time. They don't really mature for 30 years, but maybe you'll have them for 10 years. And they're giving you 2%, and you're financing them with deposits or borrowings. And suddenly those are costing you 5%. Now you might say, well, I'm not selling my mortgages. I'm just sitting on them, and I'll just hold them until they mature. But in the meantime, you're going to go broke if you did this, if you did too much of this, because you are getting 2% a year income and 5% a year expense. So it's costing you 5% to finance or to fund the assets which are yielding you 2%. Now that's the principal reason Silicon Valley Bank went broke. Now in a private bank, of course, the depositors can say, I've had enough of this, I'm taking my money out. And then they become insolvent in the serious sense, and then they fail. They don't go into bankruptcy in a bank under our laws. They go into government control, receivership of the Federal Deposit Insurance Corporation, and the government disposes of them in some way, maybe sells them, maybe liquidates them. But this notion of investing in assets which are very long and always have the same fixed rate for years and years and years, and funding them with deposits or borrowings whose cost rises with the market, that's a fundamental extreme risk and classic mistake in banking. It's what put the savings and loans out of business in the 1980s, when the savings and loan industry collapsed, basically. It's what Silicon Valley Bank and others did. And guess what? It's exactly what the balance sheet of the Federal Reserve looks like today.
Mm-hmm.
The Federal Reserve owns $2.5 trillion of mortgage-backed securities, that of 30-year mortgage loans. And their average yield is approximately just a little over 2%. On top of this, they own $5 trillion of long-term treasuries. Treasuries that mature out to 2050 with very low yields. Their average yield is a little less than 2%. And it is costing the Federal Reserve today approximately 5.4% to fund these investments. So even though they say, well, we're not selling it, oh, well, and what's their mark to market? Well, their mark to market, is minus $1 trillion. They have a mark to market loss on their securities portfolio if they had to either say, what are they really worth on the market, or if I really had to sell them. Of course, if you really had to sell them, they wouldn't be worth that. They'd be worth much less. If a gigantic investor dumping stuff on the market would drive the price down. But at current prices, they have about $1 trillion in market value that's less. That is, they take the security and look in the market and say, what's its price? What did I pay for it? And if the price is a lot less than I paid for it, that's a loss. Just like if you bought some stock at $100 a share and it went down to 80. Well, that's a $1 trillion mark-to-market loss. But then it is said sometimes, well, but that's just the mark-to-market. They're not really going to sell them. They're just going to hang on. True. But in the meantime, in order to hang on, you have to be paying over 5% to fund them. So what is your result of that position? Well, it's income 2%. Cost 5%. And I like to say, you don't have to be a certified financial analyst or a PhD in economics or an expert in central banking to know that if you're lending money at 2% and borrowing money at 5%, you're not going to like the net result.
Right.
And so the Federal Reserve in the last 12 months has lost $100 billion doing the same thing that Silicon Valley Bank did, doing the same thing the savings and loans did in the 1980s. And all this is unprecedented. This creation of the balance sheet that they did is unprecedented in their history. And you have to say, really, really quite fascinating. Among the things it demonstrates is it shows how true it is that the Fed doesn't know the financial future any more than anybody else. They got themselves into this colossal loss. And I think everyone would agree that the leadership of the Fed did not intend to lose $100 billion. And they're going to lose another 100, by the way, in the next year. So they didn't mean to do that, but they took a risk without knowing what was going to happen. And so here we are. So it's a good example of a fundamental problem. If you think central banks are going to save you by managing the economy in a good socialist dream, the answer is they're not. And they're not for the great Mises and Hayek reason is that no one can have the knowledge to do that. And the Fed doesn't have the knowledge to do it either.
Exactly. So before we move on to like the more philosophical implication, like what does it all mean? You're going to think I wasn't listening. I know what you're saying, but I want to make sure the listeners got that distinction you made between an unrealized capital loss and like a cash flow mismatch, because I think some of them might be thinking, what do you mean? Like the Fed creates $1 million and, out of thin air electronically buys $1 million worth of bonds, and then that's it. And it just sits on, and yeah, had they known rates were going to rise, maybe they should have waited and they could have, but what do you mean it's costing them 5%? They created the money. It doesn't cost them money. The Fed's not borrowing money. The Fed creates money.
Yes.
So can you explain
yes, the Fed
that?
is borrowing
No,
money.
I know, but I'm getting in the head of
And
some.
how much money? Yes, you're right. And how much money do they borrow? The answer is $5 trillion. Some of the money the Fed borrows are deposits, like any bank, and they have to pay interest on those deposits. And they pay, as I said, about 5.4%. Now, if interest rates go higher, it will be more. The Fed also borrows money from the money markets in what are called repurchase agreements, which are secured borrowings where the Fed gives its treasury securities to, let's say, a money market fund. The money market fund lends the money to the Fed, and that they pay 5.3%. So thank you very much, Bob, for pointing this out. Yes, the Fed, although it creates money on these deposits and these borrowings, it has to pay a lot of interest and a lot more than there is income. Now, there is a part of their balance sheet on which they do not pay any money, and that is the amount of currency in circulation. So the $5 and $10 and $1 bills that you've got in your wallet do not give you any interest. And the Fed literally prints them in that case. It's literal printing. And they get interest-free funding. It costs them zero. And how much, you may wonder, currency of United States paper currency is there? The answer is $2.3 trillion. And a lot of it, it's in our country, but a lot of it is also in the wallets in many other countries where U.S. dollars are used instead of whatever local currencies are there. Now, if you only did that, and then you invested the money at current rates, let's say you had $2 trillion, and you just bought treasury bills with it, and those paid you 5%, then that would be $100 billion a year profit. We call that the seigniorage. That's the profit that the Fed makes from having a monopoly of paper money issuance. There's nothing in nature that says the central bank has to have such a monopoly. That's a political grant by the Congress in order for the government to make money on the currency issue. In the 19th century, private banks issued currency. So you could have, say, a $2 bill from the Third State Bank of Skunk Creek, Wisconsin, or something. But that was all taken away politically and replaced by a Federal Reserve monopoly. And that monopoly is enormously valuable and profitable. So note, if they had stuck to that, just the money that's literally printed, and investing that, they would have made something like, these days, $100 billion a year. But by their unfortunate speculation of investing very long at low rates and borrowing at floating rates or short rates, they've not only lost the whole $100 billion that they would have made on the currency, but they lost another $100 billion on top of that by making themselves into the biggest, I like to say, the biggest savings and loan in the history of the world is inside our Federal Reserve, and that has been a very unfortunate speculation for them. Now, when they lose that money, they're spending your money, ladies and gentlemen. When the Fed loses money, that's money that the Treasury does not get it increases the deficit, and it ups the debt of the United States. So the Fed is not just playing with its own money. It's already lost all the shareholders' money they invested in the Fed. It's now losing your money and running up the deficit. And it's doing this with no congressional approval. It did this on its own. Very interesting. Now that's going to take us into independence. But before we get there, I did want to pick up, Bob, on one thing you said. You said the Fed could print some dollar bills and buy a tank. That is not how it works. The Treasury issues some debt. The Fed buys the debt. The Treasury gets the cash. It's actually a deposit in the Fed. And it uses that cash to buy the tanks or pay the welfare or build the roads or whatever the government is spending its trillions of dollars on. So by buying the debt of the government, the central bank finances the government. And if it's financing that by creating money, which it does, we call that monetization. And this is the reason why now it has become the case that every government has a central, virtually in the world, virtually, every government has a central bank because it's so useful to the government. What do governments want to do? They want to spend money to make friends and buy votes and expand their power. Well, what do you do if you're out of money? You sell some debt to your central bank. The central bank buys it and then you spend it. So central banks are enormously valuable to governments. When you read the public relations statements of the Federal Reserve about what it's there for, you never find we're there to finance the government when it needs it. But it's actually the most classic reason why all central banks exist. Going back to the Bank of England in 1694, when the deal was very clear. We'll give you this charter if you lend money to the king so he can fight wars against France.
Yeah. Just to clarify for people who may have been jumping around, I was presenting what a listener might think happens. So I know that they go through the debt, the Treasury debt.
I know. I just wanted to clarify.
Okay, good. All right. I've got a book with the Institute on money mechanics. I got to make sure, we're not worrying about, this guy doesn't know the first thing about it. So can you, I suppose this is great stuff, and I'm sure but some people are like, okay, so what does that mean? Is the dollar going to crash next year because of all this? What's the implication of this? If a company's insolvent, that's kind of bad, right? So does that carry over here?
No. And it's because of this odd ability. Now, note, under a gold standard, the central bank can go broke like anybody else because it can run out of gold and it can't make any more gold. But it can always make new entries on its books to credit accounts. It can always order the government currency operation to print up some more $100 bills. So it can't go broke in the sense of not paying its bills, but it can keep on monetizing government debt, pushing up on inflation, and it can keep losing money, which is actually taxpayers' money, which is running up the deficit, and therefore the overall debt of the country. They really have to. An old friend of mine says, well, you really have to look at the Treasury and the Fed as one thing. They're really intertwined with each other, and that's true. Under the original Federal Reserve Act in 1913, a very little known fact is that the chairman of the Federal Reserve Board under the original act, do you know this, Bob?
I'm not sure what you're going to say.
The chairman of the Federal Reserve Board under the original Reserve Act was by law the Secretary of the Treasury.
I could bluff and say I knew that, but I didn't know that. So,
so that shows you how they understood in the beginning. This thing was tightly intertwined, and now the Secretary of the Treasury and the Chairman of the Fed see each other all the time, talk about these things, and strategize together. And I guess so it should be, but what it shows you is The Federal Reserve is part of the government and hand in glove with the Treasury, both for financing the government and for other reasons. And we get a lot of discussion about whether the Fed is independent. It's not. A couple of generations ago, they had a saying, which I think is very appropriate. They used to say, is the Fed independent? Well, it's independent within the government. Okay, what do you think that means? Well, for one thing, it means not really independent. They're very much involved in the government, and we have to understand that. And in my opinion, and we're going to talk about this some more actually at the forthcoming Mises conference in Auburn on the dollar. In many important ways, the Fed should be less important because it should be in a system of checks and balances, not with the Treasury, with the Congress, with the elected representatives of the people. That's really the constitutional design. And in my opinion, we need to move in some important ways back toward that.
Maybe just one final question here. And this is all great stuff. I'm sure the listeners are learning a lot here. There might be some puzzlement, though, because before you said the Fed would not have intentionally painted itself into this corner, that they miscalculated. But then you're also seem to be saying there's no real ramifications for them. They can just print money. So can you just clarify, like, why would the Fed not want to be where it is right now if it can always just print money?
Well, they don't want to. There are several things. They don't want to print more because that printing more is inflationary, and they've already created more inflation than they should have, or than they wanted to, or thought they would. Mm-hmm. Another great example of their inability to know the future was all their wildly inaccurate forecasts of inflation. They do not, when they are designed on purpose to make a profit through the great money printing monopoly that I told you about. It's embarrassing to lose money. You know, if you're a financial professional, don't like losing money. It raises interesting questions like we're thinking about. And this, by the way, is not only in this country, but in many countries right now, because many central banks did the same and are debating, well, what does it mean that our central bank is technically insolvent and to spend all its capital? Then the Fed is worried about, well, does this create a political reaction? The members of Congress say, well, look at these guys. They must not know what they're doing. Mm-hmm. We better clamp down. That's what they really don't want. Actually, it's what I think would be a good idea.
Right. Okay, great. Yeah. So that helps reconcile, understand that, so even though it's not that they need to shut their doors and say out of business, fire sale, still this is awkward for them at the very least. To be in this position.
Very awkward. It's awkward at the least, and it's certainly politically threatening, and it's credibility threatening. Well, what kind of a claim is it that you're making that you should be in charge of so-called managing the economy and setting interest rates and printing up money and influencing the behavior of financial markets and therefore the allocation of credit and resources and supposedly guiding the economy? Well, if you're so smart, how come you just lost $100 billion this year and going to lose another $100 billion next year? That doesn't make you look too smart, does it?
Not at all. So at the very least, it helps shatter the illusion. So
yes, and that way it's quite useful, I think.
Yes, right. So it is actually probably a good thing that it was very expensive
from our
lesson.
Point of view.
Yeah, it's an expensive lesson, but hey, any way to teach the public. Well, my guest this week, folks, has been Alex Pollock. We'll put a link to your website and the book you mentioned, Alex. So thank you for your time. This has been very informative.
Thank you. It's great to be with you. Thanks a lot.
And thank you, everyone, for tuning in. We'll see you next time.
Check back next week for a new episode of the Human Action Podcast. In the meantime, you can find more content like this on Mises.org.